Hi everyone, apologies that this has taken too long from our end. We were experiencing some technical issues today. Um, so what we are going to do, we have Mike Mackenzie today to take us through insurance. Just thought that it's good to have a guest speaker in the sense that for a topic that I'm not too comfortable discussing, I will always get someone to come and explain to us about that. We shall keep it really short, just given the fact that we have taken a lot of time. But just to provide context, is that we have done a couple of things. We have looked through personal financial planning. What are the key steps? What should we do? We did things like you need to do your budget, you need to do your savings, but as you invest, then the way you can invest through unit trust, through fixed income. So today we thought what makes sense is for us to look at life insurance as a way of securing your investments. But before I just wanted to provide some context in terms of what is insurance. Yeah, most of us have had insurance in one or another. Maybe your car insurance, maybe you are burglary or something like that. So life insurance can be divided into largely two. There's the life policies, which are largely investment products. So you're investing for your kids' education, you're investing for when you retire or things like that. Then there's a general insurance, which is when you think about general insurance, is anything about your car, things like if your house caught fire, how do you start from there? If you lost your job, do you have a cover that maybe you get paid for 6 months or things like that? So what I will really do is just give it over to Mike, because Mike is one who maybe understands more about insurance. So Mike, I think you'll give us a brief background of who you are and why you're the right person for this to take us through this. So asante, Mike.
Okay, thank you very much, Liz. And good evening, everyone. So I'm going to take you through this presentation that talks a little bit about insurance. And apologies once again, because of the technicalities, I'm forced to present this from the car. We've already left the office. So the first part is talks about how basically insurance works. The topic is around insurance as an investment. So the first thing is the plan enables a client to build up a fund of a middle to long term. So we're looking at 5 years and above. That is one of the major advantages of saving through insurance. There's also another advantage that you have a predetermined amount that you set aside every month. This could be 10% of your income. This could be 15 or 20% of your income. And therefore you plan in advance and you start setting aside a certain percentage. The other advantage is that the annual bonus, insurance, at the end of the day, the biggest objective is to build up a fund and also to ensure that your family is secured should death or disability occur. Now, insurance companies, depending on the fund's performance, pay a bonus annually, which ranges between 2% to 8%, depending on the performance. If you look at that, come end of a certain period, if assuming you wanted to contribute to build up a fund of 1 million, that fund could have grown to 2 million shillings. Then we have also the fund assists to meet future financial obligations. The COVID has taught a lot of Kenyans a big lesson. We've seen massive job losses. We've seen businesses closing down. And basically people have been affected financially. Those who had the opportunity to save, whether an organization or at an individual level, they've been able to manage the situation, and they can manage for a period of months, depending on the fund that's set aside. So this fund assists to meet future obligations. And here we're looking at things like buying a property. We're looking at taking your kids to university. We're looking at building up retirement fund for the future. And because of that, you're able to build a fund and have a graph grow as is shown in slide number 3. So yeah, so this is what I was talking about. The most important thing is that you are able to build up a fund over a period of time. And because it's a forced saving, you build up a fund over a period. If we go to slide number 4, the next slide. Yeah, okay, let's just go back to that slide so that those who probably are not seen, they can, yeah. So again, we've talked about the ability to build a plan over time. We've looked at the predetermined amount. We set up an amount, whether 10% or 20% on a monthly basis. And we've seen also the advantage of ensuring that you have a fund that meets future financial obligations. So let's go to slide 4 now. Slide 4 gives the benefits of an endowment policy or a benefit of saving through insurance. So the first benefit as seen on the screen is that you can develop a saving culture. Saving is not easy. Saving over time has become a very difficult thing to do, and therefore one is able to develop a saving culture over time. The second benefit is that you're able to build an asset. When you're saving in insurance, you're able to build or create at inception an asset, which is called sum assured in the insurance language. So assuming you want to build 1 million shillings over a period of 10 years, that is an asset by itself. So in essence, what that means is that should death or disability occur, then your family is assured of an amount that can help the family should a calamity occur in the future. Then we have a very important benefit that policy document can be used as security in a bank. You can borrow depending on the value of the policy over a period of time. So assuming you've saved 300,000, then that in essence means that you can borrow maybe 30% of that money. Tax benefit is one of the, again, very important benefits that occurs when you're saving in the insurance industry. The government pays, gives a rebate of 15% per annum. So we are saying that assuming you are putting 10,000 every month, the 1,500 that is set aside as a saving, not as a saving, but as a tax benefit, which essentially is a saving that you have built over time, that will have built over time. Someone, for example, does not even earn a bonus on interest from an insurance company, and there's a 15% tax relief on a yearly basis. That's equivalent to you've earned another 15% automatically. Then we have maturity payout, which is also tax-free. We all know that there's a lot of tax in everything, whether pension, whether retirement, or if you sell a property, the taxes are everywhere. But this is one investment that is tax-free. You're paid your amount clean. Peace of mind, very important, is one of the biggest investments you can have in life, that you have peace of mind when you have life insurance. Should death occur, should disability occur, should any of those calamities occur, then you have peace of mind. Then there's also confidence. Insurance enables people to take very big risks. If you have an insurance, assuming you buy a car today, you take a comprehensive cover, the car is worth 2-3 million. You are sure that should calamity occur, the accident or his car is stolen, then that gives you peace of mind. Business people are able to take very big projects because the performance bonds and the insurance basically gives you that confidence to move forward. We can go to the next slide. There are challenges, however. One of the biggest challenges, we look at things like Harambes, over reliance or relatives, friends. This is one of the biggest entrances in insurance, building up an asset or using it as a security over time. So people forget, people don't take it very seriously, and because they know that should something happen, this your brother will be there. Lack of a saving culture, again, is a big challenge. This probably we can say it is an African culture. At times we have people say that it is a culture, but culture also can be created and formed over time. Disposable income is a big challenge. Income in this country and Africa as a whole is low. So sometimes people don't have enough to put aside. And then also people lack long-term goals, probably again related to the first point or second point of the culture. I think up to there, the last slide that I wanted to show there is putting aside something for tomorrow is very critical. So we are reminded that today you get some money, don't consume everything. Don't basically consume everything. Prioritize saving. And once you start building up a fund over time, you feel secure because you have a fund that can come in terms of emergency, can take care of your financial obligations in future. And this can be done by setting aside a certain percentage on a monthly basis. Thank you.
Thank you, Mike, for taking us through that presentation. So there are some questions here. One of the questions is, these challenges are for the insurance company, not the insured. The challenges that you enumerated there, there's someone who wants to understand, are they for the insurance company or the person who is being insured?
Okay, let's go to the challenges. This slide. So they are basically for the person, the insured, they're not the insurance company, because they affect the person saving. Okay. I don't know if I've answered the question.
Yes, you have. So from maybe a question for me. So first of all, how do you tell which policy is the right one for you to invest in? What factors do I need to consider when I'm determining what policy to invest in?
Okay, good question. Now, insurance products are very many. And the first thing is for an advisor, financial advisor, to understand the client's needs based on what they want. There are those who are looking at saving for their own products, for their own expenses, maybe to buy a house and that kind of a sort of a thing. There are those who want to take insurance for their kids, educational saving, an educational fund for their kids. There's someone else who want to take insurance for the spouse or for a business partner. So this depends on the discussion that you have with our client, and then from there you're able to assess and recommend the right product. There are those also want long term. There are those who want short term. If, for example, you are young, long term is always good. If you are a little bit older, maybe in your 40s, 50s, then shorter term again is applicable. So all those factors come to play.
Okay, so I need to know about what you said. That was one of the things that we don't have as a country is we don't know our goals. So maybe one of the things that one needs to do is during personal financial planning is to determine the goal setting is very important for you to before I approach an investment, an insurance company. So the question I have is it better to go directly to an insurance company or is it better to use an agent?
Okay, insurance companies also have their own tied agents. There are many people offering financial services as consultants, as independent financial advisors. So again, this depends with, you can go to either. But of course, if you go to one company, you may not be able to get all the solutions that But if you come to me, I'll be a little bit biased, of course, to my company. The good thing is that the solution, the products are almost 100% similar. A few features here and there deviate. So again, all insurance companies licensed in the country can give a solution based on the needs that you have.
So there's another question that, is it possible to give a summary of the short-term insurance policies an investor would need? Maybe short-term, short-term policies that
Yes.
an investor would be looking at, or maybe just a normal person would be looking at, that these are the things that you might really need on an ongoing basis.
Okay. There's one product we call a term policy. So it can be a reducing term or it can be an increasing term. So how it works is that, for example, if I have a liability of million shillings, assuming I've taken a loan about 4 million shillings. So as much as the bank will give me credit life, it's always advisable for me also to cover that liability. I can take a reducing term policy of 4 million that will cover only the risk. It's not a saving product. At this, it will not be more of a saving product. It will be more of a cover for the risk that I've taken of 4 million. So as I repay my loan, the liability or the sum assured or the loan basically reduces. So until it reaches zero, then the policy lapses or that becomes to an end, it gets terminated. So those are some of the short-term policies that investors take to just make sure that they cover the risks that they have. And again, it's very applicable for even young families. Assuming you have a very young family, will give you a very big cover in terms of the sum assured, in terms of the amount of cover, because it's not a saving product. So the saving element can be done separately, and therefore you cover the risk so that should death or disability occur, or even critical illness, then your family will be paid a certain amount, the sum assured now that you had that projected.
So maybe more specifically and I'm just reading the charter, more specifically, are there specific insurances that a person who is invested in real estate should have? Specific to real estate investments, maybe?
Yes. So real estate, the first thing that we'll always recommend is a mortgage protection cover. That should you be, should death or disability occur, then your house will not be taken by the financials. The insurance company will pay off the loan. The other one would be what I've talked about, probably a term policy or even a whole life policy that takes care of the liability should it occur. And therefore, as the mortgage pays off the mortgage insurance pays off the mortgage, then your family also should have a capital. The term policy now will give the family capital to be able to have quality life, because again, there's no point of staying in a nice house and the family is struggling. So we recommend such products. And life insurance now comes in because all products of life insurance, whether it's an endowment, whether it's a term policy, the biggest objective one is to ensure that there's a lump sum, a capital that you are building in advance that can take care of the family should death or disability occur. But at the same time, should you go up to the end of the period without any calamity occurring, then security value again is paid to you and you're able to continue the quality life.
The other question is for people who are taking motor vehicle insurance, what does comprehensive insurance cover?
Okay, the comprehensive cover will take care of own damages, that is damages to your car. You see, we've involved in an accident, of course, the third party, that is the other car, or whether it's a person or whether it's a gate that you have crashed into, will be repaired in a normal third party insurance cover. So comprehensive comes into, of course, the premium is higher. It comes in now to take care of also your own expenses. It can also be enhanced to give you things like, like maybe a car. Should your car be involved in an accident, it's in garage for a long time, then you're given a higher facility is inbuilt there. You can also, there are other small benefits that you can build to enhance a comprehensive cover, but basically it ensures that your own car also is repaired.
Sorry, from a fixed income perspective, from an investment perspective,
Yes.
the question I have is that are there investments that are tailored towards a specific investment? So for example, fixed income, investment in the equities market, or maybe something like that, or commercial paper, or that one, it has to be from the issuer's perspective, or can I, as an individual who has invested in fixed income, come and take an insurance cover?
Okay, right now in the country, we don't have specific products for the loss of interest or maybe the capital itself. So we don't have specific cover for that here in the country, but I think outside the country, those covers are available. However, the most, this is where insurance also comes in now, just to give, as I said earlier, it can give you the confidence to do bigger things or involve yourself in bigger projects. Of course, the fixed deposit can also be used as a security. Your own life policy document can be used as security, collateral security, to borrow even or even to do bigger things in life. Yeah, but specific to your question, no.
So the question I have, and sorry, maybe to put you on the spot, I know you work for an organization, but I'm just trying to wonder, what are the factors should they consider? Maybe I've decided that I want life insurance, for example, and this is the term I want. How do I decide versus various companies? How do I decide who to go to?
Sorry, you disappeared.
I'm asking, so I've decided that I want to invest. I know my goal is 10 years. So how do I decide to go to company A versus company B?
Okay, many factors come into play. One is the relationship. You know, services is all about relationships. So, and that's why if you look at insurance worldwide, it is more of a push product where agents go out or salespeople go out, canvass about the product, and basically educate clients about the products. So being a service, the first thing is relationship. So you are likely to go to a place where you have good relationships, respective of the company. And that is what we've noticed over time. Secondly, of course, the services, very critical of the company. And then probably thirdly, you'll be looking at returns. Different companies will give different returns.
And maybe
depending on the fund management. But what we've seen is that, sorry?
Sorry, no.
Hello?
Hello?
Yes?
Sorry, what I wanted to ask about returns is can you actually say an insurance policy is largely an investment or to cover risk, in the sense that, I don't know, do the returns beat inflation over the long term?
Okay, it is insurance. Let's start by insurance. Insurance is normally not an investment per se, but people use that to do bigger things in terms of taking insurance covers that are high, that can give them the muscles to do bigger projects, or even to, for example, if you've taken a big life cover and the sum assured is big enough, it has a big value, a surrender value, you can use that to grow your investments. Insurance therefore is not as the best channel for investment. However, the return, that is the sum assured over time, I've noticed that at times it beats a normal saving returns, saving account return that is given, the interest that is given by a majority of banks. Now, about beating inflation, I don't, because average inflation is about, is normally towards 7-8%, on average over time. So I'll not confidently say that it can beat inflation from that point of view. But it gives number.
So maybe the next question is about credit insurance. What does credit insurance cover?
So again, remember when a bank gives credit, the credit life policy in the bank, when you take a loan in the bank will cover itself. It will cover itself from should death or disability occur, then they will not be paid the principal amount. They will lose money. So banks normally ensure that when you take a loan with them, you fill that form, and therefore it covers the bank so that they don't lose money should the described calamities, risks occur, and most of the time it is death and disability.
What I'm just with the current ongoing, maybe it's something that comes into my mind is I've lost my job. Is there an insurance that protects against maybe job loss over a period of time? Maybe something that I can continue getting my salary. Is there an insurance like that I can continue getting my salary over a period of time as I look for a job as a transition?
Yes, and in fact, most the credit, yes. The banks, I mean, insurance companies have that cover that will take off maybe 3 or 6 months or 9 months, depending on the premium that the bank is going to pay. So there is that benefit that should you lose your job, of course, there must be credible evidence that you are employed and you lost your job. So it is there, but again, it's in multiple. It depends with the bank now, how many multiples they're going to look at to do that. So there's such a cover, but most of the time it goes up to about, it starts with 3 months, 6 months. I think some can go up to 9 months, but average is normally 6 months. So after that,
is it for the loan or for me as an individual that I can continue getting an income?
No, that's loss of income. That is mostly because of the liabilities that you have taken with institutions like banks.
I don't know if there's any other questions online. I think Mike has really been graceful and answered quite a bit of our questions. I think in case you have any questions, I can still redirect them to Mike, and we come back. I come back to you. This has really been good. I think it's been like insurance 101 for some of us, and so we are really grateful, Mike. And
and probably just to add on, because we did not touch on the group life, in case the organizations also will take retrenchment cover for the employees. So again, that's normally we discuss with the corporates when they are taking covers. We call group life cover.
Okay.
Yeah, but thanks a lot. Yeah.
So when let me just ask you, when you send up, like now in the current situation, you have a group life cover. When you send someone on unpaid leave, is that part of? Can they claim from that?
No, unpaid leave. No, that's not retrenchment.
Oh, that's not retrenchment. Okay. Okay.
Yes. Yeah.
Thank you.
Okay. Thank you very much.
So thank you so much for joining us. It's really been a pleasure. We do this every Wednesday at about 4 to 5, just trying to give financial literacy and just making sure that we are actually feeding the public with the information so that someone actually can take can invest rightly, and just make sure that they are well covered for their future. So goal setting, those are things that we shall be going through, and just making sure that I've invested so that I can know the day that something happens to me, my family and myself are well taken care of. So thank you so much for joining us again. We meet again next week. And for next week, we shall be doing debt management. I know some of us have a couple of issues in terms of debt and how we get into debt, and some of the things that have been alluded to today, what you can do about debt. So we shall actually cover debt management next week. So kindly join us at the same time, and hopefully we shall not have a technical challenge. Thank you so much.
Thank you.